Hi, I'm Brian. I'm an investment advisor. I manage portfolios for investors like you. And today I'm going to explain the 7 reasons that traditional passive buy and hold investing is dead. Before I get into the 7 reasons, I want you to know that this discussion is based on a white paper that's available on my website. For a free copy, just go to alpharockinvestments.com/7. Reason number 1, passive investing ignores the golden rule of successful investing. The golden rule of investing is as intuitive as it is essential. Buy low and sell high. The objective is to acquire undervalued assets and then sell them when they reach or exceed their intrinsic value. Achieving this requires a proactive strategy rooted in valuation. Traditional investment advice to buy and hold disregards price. By design, a passive portfolio remains fully invested regardless of market conditions. Advisors who prescribe passive investing believe your entry and exit points should be dictated solely by your age, your risk tolerance, or your immediate cash needs. This approach ignores the fundamental value of the underlying investment, the very metric that determines long-term success. Passive investing is static. Whether the market's at an exuberant peak or at a terrifying trough, the mantra remains the same: buy and hold. You're told to ignore fundamental value entirely. The price at which you enter doesn't matter, and the price at which you exit is an afterthought. The only constant is that you stay invested and continue paying management fees. Passive investors are price takers. They must accept whatever price the market offers, regardless of whether it represents a sound investment or a speculative bubble. Using a strategy that ignores price is fundamentally illogical, and it raises a valid question. Does ignoring the golden rule of investing serve your interests or the interest of the person recommending it? Reason number 2, passive investing disregards your true tolerance for risk. Passive investing hinges on a dangerous myth that you can possess unwavering fortitude during market turmoil. This notion is decisively refuted by reality. When bear markets take hold, the buy and hold mantra becomes a grin and bear it trap. After 25 years at 2 larger advisory firms, I've met with many retirees who lost more than half of their life savings in both the dot-com crash and the great financial crisis by following a buy and hold strategy. They weren't weak. They were following flawed advice that ignored their very nature. Unless you can sleep soundly while your retirement plan is cut in half, passive investing is a gamble on your own psychology that you're likely to lose. Have you ever wondered about the true purpose of those risk tolerance questionnaires? They're mainly to protect the advisor and the company they work for. They're legal shields designed to prove that you signed off on the risk so that when markets crash and their strategy fails, you can't sue them. They measure a hypothetical version of you, not the person that has to pay bills in a financial crisis. Most investors overestimate their appetite for loss. Passive investing neglects the predictable psychological pressures that force people to stop the bleeding at the worst possible time. In the face of inevitable market cycles, a strategy that ignores human emotion isn't just flawed, it's a failed philosophy. Reason number 3, traditional investing does not provide true diversification. The narrow focus of traditional passive investing, primarily to domestic stocks and bonds, represents a glaring limitation in today's diverse investment landscape. By adhering strictly to these conventional assets, passive investing inherently overlook an array of potentially lucrative opportunities, including currencies, commodities, natural resources, infrastructure, emerging markets, precious metals, and digital assets. Each of these asset classes provide a unique risk-return profile and potential diversification benefits, along with uncorrelated returns, inflation hedges, and potentially higher growth areas. Passive managers may pay lip service to some alternative assets, but when you look at how their portfolios perform, they go up and down in lockstep with the domestic stock and bond markets. An active manager, unconstrained by portfolio mandates, has the flexibility to exploit a much wider investment universe, potentially enhancing portfolio returns and managing risk more effectively. Reason number 4. Despite what they say, timing is everything. Conventional wisdom says it's not timing the market, it's time in the market. But in reality, the difference between making a fortune and losing one is above all a matter of timing. Successful investors will tell you timing is everything. The best investment in the world can become the worst if bought at the wrong price, and the worst investment can become the best if bought at the right price. Amazon has been one of the best performing stocks of our lifetime, but between 1999 and 2001, shareholders lost 90%. The Japanese Nikkei serves as a sobering reminder that time in the market is not a guaranteed wealth builder. Investors who bought into that index at its 1989 peak endured a staggering 34-year wait just to see their nominal principal return in early 2024, a lost generation of capital. In the dot-com era, a mere 30-month difference in timing dictated the next 15 years of an investor's life. Those who entered the NASDAQ 100 at the March 2000 peak watched their investment crater by 80% and didn't fully recover until 2015. Meanwhile, a tactical investor who entered in October of 2002 were already sitting on a 400% gain by the time the 2000 era investor finally saw their first dollar of profit. While passive proponents preach patience through market downturns, they overlook the crushing psychological toll and massive opportunity cost of waiting years or decades just to break even. True wealth creation isn't about simply enduring losses. It's about strategically avoiding them and actively positioning your capital for growth, especially for investors who are near or in retirement. Reason number 5. Passive investors' narrow focus on low cost forfeits active alpha. In 1999, when I began my career at a larger advisory firm, active management came with a premium price tag, often starting at 2.5% per year. Even passive managers at the time charged around 1.5%. Back then, choosing active management was a significant financial trade-off. Decades of fee compression have fundamentally changed that math. Today, some active managers are still charging 2% or more, but they're rare. At Alpha Rock, our highest fee of 1% is now in line with what many investors pay for purely passive management. This shift has been driven by a revolution in investment infrastructure and advances in technology that have drastically lowered the internal cost for advisory firms. The underlying expenses of mutual funds and ETFs, the ones we use to build your portfolios, have also declined significantly. Many investors don't realize that the total cost of hiring an active manager is often the same as hiring a traditional passive advisor. You're no longer paying a premium for human oversight. You're simply choosing how that oversight is applied. Active managers remain a rare breed in the investment industry, especially those offering low fee structures. But fortunately, you've already bridged that gap. Technological advancements in our industry, combined with risk management and the potential for enhanced returns offered by advisors using an active strategy, offer investors a compelling alternative to the traditional passive buy and hold investment strategies. Reason number 6. Risk increases with time. It does not decrease. Every major stock market in the world has declined by 70% or more at least once, and they've all had multiple declines of 50% or more. The risk of catastrophic loss does not decrease with time, it increases. Nobel laureate Paul Samuelson said, quote, "The longer you own stocks, the greater the risk of devastating loss," end quote. Common sense confirms this. Think about driving your car. Does the risk of having an accident increase or decrease with time behind the wheel? Wall Street misleads investors when they suggest that active management is inherently more risky than passive investing. Active managers can reduce risk by tactically shifting portfolio holdings. Using the car analogy, the less you drive, the lower the probability that you'll crash. During periods when stock market prices are overvalued, it makes sense to actively shift allocations to less risky investments. For investors who value risk management, active management and diversification to uncorrelated asset classes offers benefits that passive strategies cannot provide. Reason number 7, history is not a monolithic tale, it's a nuanced chronicle. Stay the course is a seductive yet perilous mantra for passive investors. While proponents tout the long-term upward trajectory of markets, this perspective dangerously downplays the devastating impact of historical market crashes like 1929, the dot-com bust of 1999, and the Great Financial Crisis. For passive investors, these weren't mere historical anecdotes. They were periods of real devastation. Watching their clients' retirement savings disappear, passive advisors were preaching, "Stay the course," and "market history shows," and "over the course of time." The years and decades required to recover from these devastating events contrast starkly with the promise that markets always recover. To dismiss these historical precedents as irrelevant is to ignore the inherent cyclicality of markets. A passive portfolio tethered to an index, regardless of its altitude, will be crushed in the next bear market, just as it was in the past. If you're ready to get off the buy and hold roller coaster, or you just want to share your thoughts or you have questions, contact me directly anytime. Before you go, please like this video and subscribe to my channel. It helps me reach new viewers. To learn more about our services, subscribe to our weekly Market Forces email newsletter at alpharockinvestments.com.